Okay, picture this. You've done absolutely everything by the book. You've filed your taxes, you hired a pro to make sure it was all perfect, every single detail. You are, for all intents and purposes, the model taxpayer. And then, one day, you get a letter from the IRS, and suddenly, you're on the hook for a huge tax bill. It's not just a scary thought experiment. This is a true story, and it shines a light on a hidden trap that could catch any crypto investor completely off guard.
And let's be super clear here. This isn't some hypothetical. This is a real-world story about a taxpayer who was, by all accounts, totally compliant. He checked every box, declared every gain, and he still ended up in the IRS's crosshairs.
Right? That's the million-dollar question we're going to dig into. How can a system that's designed to ensure compliance end up punishing somebody who's doing everything right? Well, the answer is kind of wild, and it has everything to do with data, and more specifically, how that data gets lost in the crypto shuffle.
So let's meet our investor. We're not going to use his name, but his actions speak for themselves. By every single measure, this person was the ideal, responsible taxpayer. He wasn't trying to pull a fast one or hide anything. In fact, he was doing the exact opposite. Just look at this track record. This wasn't a one-off thing. He started reporting all his crypto activity way back in 2019. For years, he worked with a CPA who actually knew the ins and outs of digital assets. But then, in 2025, he made a few moves, and by early 2026, boom, the letter showed up. I mean, let's just hammer this point home. He reported everything every year. He hired an expert. He declared all his gains and losses with precision. And he even correctly checked that little digital asset box on the 1040 form that trips up so many people. You're looking at a perfect record.
And that's what makes this next part so jarring. You have this perfect history of compliance, and then a single piece of mail arrives and turns a totally routine year completely upside down.
Yeah, this wasn't one of those simple, "Hey, can you clarify this" notes? The source material makes it really clear. This was a serious notice. The IRS was proposing a major tax assessment. The whole vibe shifted from routine to, well, pretty urgent. And here's the culprit, the smoking gun. The entire problem came down to this one form, the 1099-DA. See, the exchange he used sent this form to the IRS, and the big number on it, the gross proceeds from his sales, it just didn't line up with the taxable gain he reported. So to the IRS, it looked like he was trying to hide a massive chunk of income. So this is where the real detective work begins. The investor's CPA had to go into full investigation mode. Why didn't the numbers match? They had to trace every single step of the money to find out where things went wrong. Okay, this slide breaks down the whole problem perfectly. On the left, you've got what the IRS saw. They just see the total amount of money from the sales. To them, that looks like pure profit. But on the right, you have what actually happened. The investor's real gain was those proceeds minus what he originally paid for the assets, his cost basis. That form was telling a dangerously incomplete story. Exactly. This is the key question, right? The investor knew his cost basis. His CPA calculated it perfectly. So why didn't the exchange report it? Where did that super important piece of data just disappear? And here we are at the absolute core of the issue. This wasn't about fraud, and it wasn't about a simple mistake. It's about a fundamental gap in how crypto data gets tracked and reported as it moves around. This is the mystery of the missing data.
So before we dive into the weeds, let's just make sure we're all on the same page. Your cost basis is, simply put, what you paid for an asset. If you buy a coin for $100 and sell it later for $300, your gain isn't $300. It's $200 because you have to subtract that original $100 cost basis. Without that number, your taxable income looks way, way bigger than it actually is.
Okay, check this out. This is the exact journey where that crucial data got lost. Step 1. He buys crypto on Exchange A. Simple enough. The cost basis is right there. Step 2. He moves it to his own personal wallet. Now, the link to that purchase history is already a little weaker. Step 3. He uses a bridge to move it to a completely different blockchain. Now its history is getting even fuzzier. Step 4. He deposits it into a brand new platform, Exchange B. Now, what does Exchange B know? It only knows that this asset showed up, it has zero idea where it came from or about that original purchase on Exchange A. So, when he finally sells it in Step 5, Exchange B can only report what it knows, the sale price. The purchase price, that all-important cost basis, has just vanished from their records.
So here's the bottom line. The exchange that sent that 1099-DA to the IRS wasn't wrong, it was just blind. It reported the only information it had, which was the sale. It had no way of seeing the asset's life story. That purchase info was literally lost in transit.
So, how did this whole mess end? And, maybe more importantly, what can we all learn from this guy's headache? Because this isn't just about one person, it's a huge warning sign for the entire crypto space.
So the good news is they fixed it. The tax assessment was corrected. But it was an absolute grind. It took his CPA weeks of painstaking work, piecing together a transaction history that the automated systems had just completely dropped. It was costly, it was stressful, it was a nightmare.
And this is what it took to fix it. They had to go on a full-on data archaeology mission. They had to dig up the records from the original exchange where the crypto was first bought. They had to pull all the transaction histories from his personal wallet. They even had to use blockchain explorers to trace the asset's journey across different chains. This was a massive manual effort.
And this right here is the big takeaway for every single person listening. This investor's story is really just a symptom of a much bigger problem. This isn't about one bad exchange or one unlucky taxpayer. It's a systemic gap in the system. Anytime you move an asset from one place to another, from an exchange to a wallet or across a bridge, you are running the risk of breaking that chain of data and losing your cost basis.
So as we wrap this up, I'll just leave you with this one question to really think about. Is your crypto history truly complete? Do you know the full story of every single asset you own, from the moment you bought it, through every wallet and every chain, all the way to today? Because as we've just seen, having that complete unbroken record isn't just good bookkeeping, it might just be your ultimate defense.
Solve all this quickly and easily with Koinly. We're giving you a 30% discount. Link is in the description.